Hello and welcome to Trust and Estates Ask the Experts, produced by Trust and Estates and wealthmanagement.com. Today's session is Ask the Experts, Private Foundation Basics for Financial Advisors, and it's sponsored by Foundation Source. I'm Susan Lipp, Editor-in-Chief at Trust and Estates, and I'll be your moderator today. In a moment, I'll be turning things over to our speakers, but first I'll cover some quick housekeeping items. If you experience difficulties with audio or advancing slides, refresh your screen with F5. If you're experiencing other issues, hit the question mark button to receive assistance. At any time during the presentation, submit your questions into the Q&A window on the left-hand side of your screen. Please refer to the reaction widget down below and feel free to share your reactions during the presentation today. In 24 hours, you'll receive a link to watch the recording of this session. A copy of today's slide presentation is available for download on the resource list widget. The speakers will make a brief presentation, then answer pre-submitted questions, and then they will answer the live questions submitted by the audience. So let me introduce today's speakers. Jillian Howell is Head of Client Advisory Solutions at Foundation Source, and Alvina Lowe is Chief Wealth Strategist, Executive Vice President at Wilmington Trust. You can find more information about today's speakers by clicking on the speaker bio widget at the bottom of your screen. Now, as I mentioned, our speakers will be talking about private foundations. So just what is a private foundation? It's been said a private foundation is a large body of money surrounded by those who want some. So with that, let's get started. And Alvina, I'm turning it over to you.
Great. Thank you so much, Susan. I like that because after all, who wouldn't want to be around a large sum of money? And I think what Jillian and I today will share with you is how to think about it, how to advise our clients about it, and I'm looking forward to this. So Susan mentioned, I'm Alvina Lowe, Chief Wealth Strategist of Wilmington Trust. Wilmington Trust is the wealth management arm of M&T Bank. And in my role as Chief Wealth Strategist, I lead our national practice of Wealth Strategy Group, which consists of attorneys, trust and estates attorneys, accountants, financial planners, and various other subject matter experts. And together, we help our private wealth clients at Wilmington Trust with everything that's planning. It could be trust planning, estate planning, financial planning, and of course, also philanthropic planning, which is why the topic today, private foundations for a financial advisor, is something that you can imagine my team and I do quite a bit of. And today, Jillian and I will kind of divide and conquer in the first half of the presentation. We have some prepared remarks on the basics. And then Jillian and I will, as Susan mentioned, answer some of your pre-submitted questions. I will cover the basics of a private foundation, the 101, if you will. What is a private foundation? What are some basic attributes to a foundation? How to set one up? And what are some of the basic interplay between private foundation and other type of popular charitable entity? Then I'm going to pass it off to Jillian, who's going to talk about a lot of the more practical matters on the how a private foundation operates and what are some things to look for in its ongoing operations. Okay. All right, so I will get started, and I'm just going to send over the slides. And as Susan mentioned, in addition to your pre-submit questions, which we will address later on, please do, if you have questions along the way, submit on the chat, and we'll do our best to answer all of them as time permits. All right, so let's start with what is a private foundation? A private foundation is a separate legal entity that qualifies for tax-exempt status under the Internal Revenue Code Section 501c3. That's why many of you might have heard from your clients that says, oh, I'd like to start a 501c3, and you might wonder, where did that name come from? Well, very unimaginatively so. It is named after the Internal Revenue Code that allows or permits a lot of the things we're talking about, which is the operations of a tax-exempt entity. Now, what is interesting is that the way the Internal Revenue Code defines a private foundation is also in terms of negative, which means that it is a tax-exempt entity that doesn't meet certain qualifications. So it's almost like a catch-all. But in practicality, what that means is that it is a charitable entity that is primarily supported, or where the funds come from either one individual or a small group of individuals. Basically, a charitable entity that doesn't meet the so-called public support test. Now, there are many benefits of a private foundation, and I know Jillian's going to go over some of this later, but basically, on and large, is that if you meet all the requirements and the rules that come with it, the donor, your clients, can maintain an enormous amount of control over the charitable entity. Private foundations, by definition and terms, are long-term vehicles, right? They can last for multiple generations. So what, especially when it has a lot of money in it or a lot of assets in it, using it as a intergenerational tool that could prolong and do good for what they want to do and their legacy, and also get the next generation involved. And indeed, that's a way that we have seen very positive outcome from a lot of our clients. It helped to establish a legacy and to fund future gifting. It also provides a lot of tax benefit, which we're going to go through later, which, of course, with our clients, in addition to doing their philanthropic good, it also really helps to have a tax benefit along with this charitable work. Now, a private foundation isn't necessarily for everybody, and there are some considerations. Generally speaking, and I say this very generally, is that it does cost time and money to create and maintain one, although there are a lot of services out there, such as the organization that Jillian works in, that makes it a lot easier nowadays. There are also some nuance about it in terms of the tax benefit or the tax restriction that I do think is very important to know. Now, I know most of you listening are probably not accountants or attorneys who need to know all the specific, but I will address some of the big ones so that you have an idea as we're going to continue to talk about this topic, because I think it's important to know as a baseline, even for financial advisors. All right, so here we go. What are some fundamentals of private foundation? The form of entity. It usually is set up either as a not-for-profit corporation or a trust, depending on kind of the client's preference and what you're trying to achieve. The governance of a private foundation is typically done by either a board of directors if it is a non-for-profit corporation, or by a trustee if you set up as a trust. Now, that's the overarching governance. A private foundation can also be set up, especially some of the larger ones, so that it can have subcommittees to control certain aspects of the operation of the private foundation. So, for example, you can have a committee of directors or a committee of trustees to handle just the investments of the private foundation, the grant making, or other operations. And certainly the officers or the trustee of this entity can also hire financial advisors, for example, to help with some aspect of it, like the investments. There are a number of rules that a private foundation must follow, or else there could be some very negative tax consequences to it. And I'm just going to go over the top ones here for you. The first one is excise business holding rule. Generally speaking, a private foundation cannot, along with its disqualified persons, cannot own more than 20% of a voting stock or profit interest of a business enterprise. So if you're advising some of your business clients who are business owners, right, if they say, well, that's great, I'd love to contribute, a large part of my business into a private foundation, get a tax deduction. It doesn't really work like that, right? You cannot, in general, again, own more than 20%. There's also a tax on investment income. There's a misnomer out there that, hey, if I have a private foundation, it's a charitable entity, I don't pay taxes. That is not true. When it comes to private foundation, on your investment income, there is a 1.39%. It used to be 2%, and the law changed, so now currently it's 1.39% on investment income. So therefore, if you think about it, a lot of the bigger private foundations out there who has quite an endowment, they do pay tax. It's a lot less than a corporate kind of business entity or individual person, but they do pay tax to the tune of 1.39%, which could, again, from an absolute dollar perspective, be very substantial, depending on the size of the endowment. There is also an excise tax on jeopardizing investments. The idea here is that the Internal Revenue Service do not, I wouldn't say encourage, they want to discourage private foundations from making risky investments, right? So if you're deemed to be making a jeopardizing investment, there would be an excise tax along with that. And again, so that's where, working with your private foundation grantors, donors, and also with the trustee will be really important from a financial planning perspective. There is a minimum payout requirement. This is very, very important, and oftentimes kind of the things that we spend a lot of time on, is that for a private foundation, there is an annual requirement of distributing at least 5% of the assets of the foundation. And if you don't do that, and if you don't do that in a timely manner, there will be a penalty involved. And we'll talk a little bit about how this works later. Permissible grantees, this is also another big one, right? Oftentimes clients ask, well, I want to set up a private foundation and I'd like to make grants. Okay, well, that's great. And that's indeed what a lot of the private foundations are set up for. But there are limitations as to who could be the grantees for the grant of the private foundation. Generally speaking, they have to be public charities, which includes, by the way, a donor advised fund. Right. And if you start distributing grants for things that are prohibited or where you're required to exercise what's called expenditure responsibilities, it can get pretty complicated. You can also, in general, donate to a private foundation, which then in turn make grants to foreign charities. But again, that gets very, very complicated. So generally speaking, I would say if you're advising your clients on whether to set up a private foundation and who the permissible grantee would be, think of it almost as public charities in the United States. Okay, there are certain exceptions, but again, just broad stroke, that's what you should be thinking about. There are also prohibited transactions, which means that the IRS has a strict set of rules against what they call self-dealing between the private foundations and disqualified persons. Disqualified persons, generally speaking, are talking about the donors, the businesses they control, and close family members. The idea behind this is that the IRS and the government does not want wealthy people to set up a private foundation and then end up having kind of unfair dealings between the donor and related parties and the private foundation. So a classic one of these would be, for example, if the donor has a pledge or have some kind of commitment personally to a charitable entity, and then you have your own private foundation pay it off. That is a no-no. And again, if you violate those rules, there are severe penalties. Now, this is not by all means an exhaustive list. You can imagine there is a lot of complexity related to it, but these I would say to you as a financial advisors would be the top things to keep top of mind when you are helping your clients decide whether a private foundation is the right charitable entity for them. Now, oftentimes we get asked about the taxations of a private foundation and also the charitable contributions that the deductions that you can get. So here is a very high level outline of what the taxation of certain charitable contributions might be, and specifically to a private foundation and how it relates to non-private foundations. So generally speaking, right, if you as an individual were to donate cash to a public charity or a donor advised fund or certain foundations like operating foundations, which is not the topic today, you generally get to deduct up to 60% of your adjusted gross income. Now, this law will change at the end of next year after the expiration of the Tax Cuts and Jobs Act, and will revert back to 50% of your adjusted gross income. If, on the other hand, you were to give long-term capital gains property, like appreciated stock, to a public charity or donor advised fund, then you can get up to 30% of your adjusted gross incomes in terms of your tax deduction. Now, in contrast, if you were to donate the same amount of cash or the same amount of long-term capital gains property to a private foundation, your ability to deduct that from your adjusted gross income each year is reduced to 30% for cash and 20% for long-term capital gains. Furthermore, if you were to contribute capital gains property, long-term capital gains property to a private foundation, you will only also get a tax deduction equivalent to your basis, not fair market value, unless it's a qualified long-term capital property such as publicly traded stock. Now, have no fear, though, if you cannot utilize all of the tax deduction in current year because you reached this limit, you can carry forward your unused income tax deduction for the next 5 years. Now, when it comes to gift tax or estate tax, the good news there is no such limit. There's unlimited gift and estate tax deduction for any gift or bequest to a private foundation, again, assuming all the other requirements are met. Now, this point here about the tax deductibility oftentimes is a very critical factor when clients are deciding whether to choose to create a private foundation versus donating to a public charity, or creating a donor advised fund. So here, I thought it might be helpful to kind of lay out the two next to each other. And on this slide, I know I used donor advised fund, but this is pretty much, for purpose of this slide, synonymous with anything that is a public charity. Right, so as you can see here in the side-by-side comparison, a lot of the things are very similar, right? The things that are different is in row 3, which I say income tax deduction. Again, as I said earlier, if you were to donate cash, you could only deduct up to 30% of your adjusted gross income if you donate to a private foundation versus 60% to a donor advised fund or public charity. Appreciated asset up to 20% for donor private foundation, 30% for adjusted gross for a public charity or donor advised fund. Okay, the other big material difference is in line 5, the valuation. If you donate long-term capital assets to a private foundation, you could only get your cost basis. So let's just say, for example, I were to donate a piece of art, right? Real estate. I know we got a question, submitted before this on farmland, which we'll address later. All that, you only get a deduction equal to your cost basis. Whereas in contrast, if you were to do that to a private public charity, that's assuming a public charity will take the asset, or donor advised fund, you do get the deduction that is equal to the fair market value at the time you donate. Right, so this could often be a material difference and a driver for whether a private foundation is right for your clients. Tax on investable income. Like I said before, private foundation, there is a tax on it. It's 1.39%, which is obviously much lower than the personal rate or a corporate tax rate, but there is a rate and it is taxable as opposed to a public charity or donor advised fund. And then here on the bottom, I showed an example of, if you were to donate $10 million of asset, whether it's cash or qualified appreciated asset or other appreciated asset, what that would look like. In the interest of time, I'm not going to go through each of these, but it is here in your materials if you want to get drilled down into a specific example of how these differences work. Okay. All right, so I talked about what is a private foundation, what are some basic tax attributes. So let's talk about, let's just say your clients say, yep, this is what I want to do. I'm going to do a private foundation. Well, how do I go about doing it? Well, here I laid out the step-by-step approach. The first thing is work with an attorney to figure out what is the best corporate form. Like I said, it could be a non-profit corporate entity, in which case you have a different set of formulating documents, or you could form it as a trust, in which case you would draft, or your attorney would draft a trust document. You would then need to think about who the board of directors might be, or the trustee. That could be the founding donor or their family members or friends or outside party. And then you will have to apply to the federal government for both a tax EIN, employee ID number, and also tax exempt status, which is Form 1023. Now, depending on the type of entity you choose, if you end up choosing a not-for-profit corporation, you would also then need to draft bylaws, which include your statement of purpose and other required provisions under Section 501c3. If you decide to use a trust instrument or form your entity as a trust, all of those provisions will still need to be in there. It would just be in terms of the trust agreement as opposed to a separate entity for the bylaws. Depending on the state you live in, there might also be separate state requirement or state filing requirement. There are ongoing maintenance of a private foundation, which again, in the interest of time, I won't list it out because Jillian's going to cover that. And also in terms of moving a private foundation or dissolving one, I'm going to save that for later because we did get a pre-submit question on this one. And then lastly, before I hand it off to Jillian, a lot of people ask me this too, and I won't go into details because I know this is one of the pre-submit questions, but oftentimes, it's not mutually exclusive, right? To have either a donor advised fund or private foundations. A lot of clients sometimes have both for good reasons, and we'll cover that in later in the Q&A session. And then lastly, other popular charitable entities that people use, you might have heard of, are charitable split trusts. They are in the form of either a charitable remainder trust or a charitable lead trust. Know that, again, none of these charitable entities are mutually exclusive to each other. It is entirely possible and sometimes preferable to have a private foundation and to use it in conjunction with a charitable lead trust or a charitable remainder trust, although there are some nuances to it. I list out some of the things that you should consider here, and if time allows, I'm happy to expand on it. So with that said, I'm going to pass it to Jillian, who's going to talk about the operations of a private foundation. Jillian?
Thanks, Albina. Appreciate it. Let me get to mine here. So good afternoon, everyone. Jillian Howell. I've been in the philanthropy business for nearly 35 years now, and always working with clients to help them fulfill their philanthropy and have impact. Currently work with Foundation Source, which is really the largest provider of full service solutions in the management of private foundations. And I head up all of their client delivery and their advisory services area. So pleasure to be here. We'll start with just, the US, obviously one of the most, if the most generous country out there, giving an enormous amount of money every year to charity, $557 billion in 2023, which is extraordinary. Up 1.9% from the year before, but actually down 2.1% if you factor in a 4.1% inflation, but still incredibly large. We look at the Bank of America study of high net worth philanthropy, and 85% of affluent or high net worth households give to charity. That's compared to in the mid 50s for regular households. So that's extraordinary as well. And we'll go into, but the opportunities that's in there to help people understand how they can fulfill in their philanthropy, because it's really, we know that they're generous. We know that they give a staggering amount every year. So it's not about, the question is not whether they're giving, but it is really how much, to whom, and through what vehicles. And those are the conversations for all the advisors on the phone today that your clients are expecting you to help them think about how they can be more strategic, how they can be more impactful, and what are those vehicles. Obviously, private foundation being one of the most flexible vehicles out there, but there's also, as Albina mentioned, donor advised fund and worth to both. It's not really an either or, it can be both. And then depending on the individual, the family, and their needs and their objectives, you select one. And it isn't necessarily just the small end of the market picks a donor advised fund and the high end of the market picks a private foundation, and we'll go into that in more detail as well. If you go to the next page here, so it's creative and inspired philanthropy. This is where private foundations do shine. They offer really a flexible vehicle. What I think is kind of the gold standard for multi-generational families, for philanthropy, for legacy creation. And really the family engagement piece can often be a large driver for selecting a private foundations. And we have just an abundance of stories about that, how it's just a huge unifier across the board. So there is the most complete giving toolkit. We can go into that in more detail, but you can give to individuals. You can have direct charitable activity. You can give internationally. There's loads of different, you can do PRIs, which is program-related investments. There are just many ways in which you can give that a private foundation opens up for you. Now you have to do reporting around all of that, but you can actually do it. And it is really the best, I would think, the best vehicle for social change. And that's really because of that working or that interaction between policy, impact investing, and grant making. It's a great tool for celebrities and companies that are building purposeful brands, right? So attaching, if you like, a philanthropy aspect to their brands. A private foundations is a great way to do that. If you look at the multi-generational that I mentioned, you look at the younger generation starting a business that, is more purpose-driven. They're very conscious in how they deploy capital, and you can be very deliberate in a private foundation to do that. governance and operational, involving the family, setting up a board, setting up a sub-board of the next generation. There's just enormous flexibility there, and obviously around control as well. And we'll go into more detail on that in the questions as well. So why your clients might want a foundation? So the full ownership and control thing is really one of the biggest distinctions, and I can go into more detail on that, about the private foundation versus a donor advised fund. You have full control in a private foundation. You are, in fact, an advisor on a donor advised fund. Now, reality is, if you're going to select an organization that's a fully qualified charity, 501c3 organization, the donor advised fund sponsor is probably not going to stop you, but they do have the final say. And also in the investments, it can be a bit limited. There can be just funds there, and sometimes they can be individually invested, but again, it can have some restrictions, and it is determined by the sponsor of that charity. So you do have full ownership and control with a private foundation. You obviously can have a board, you can compensate your board, you can compensate directors. As I mentioned earlier, you are restricted in donor advised fund to give to U.S. public charities. You have more flexibility with the private foundation, certainly with donating tangible assets. In a donor advised fund, you will be required to sell those. In a private foundation, you can actually hang on to them. You can have grant agreements with who you actually are the grantees, and some donors really like that. They can lay out all of the rules and regulations of what they want that grant to be and how they want to get reporting on it and measurement on it. You don't do that with a donor advised fund. And obviously, this passed down to future generation or successors. You certainly can do it in a donor advised fund. Many donor advised funds have flexibility there, but there's nothing like a private foundation in terms of perpetuity. And a lot of times that's why people set them up. And hiring staff, as I meant, compensation, that's another attraction to it. Not your grandfather's foundation. I mean, that's really, I think, it's really about aligning your organization, aligning with an organization that can deliver all of this kind of one-stop shopping, one-stop shop to everything that you need for a private foundation. So as mentioned, Foundation Source, where I work, doesn't manage assets, doesn't custody assets, but there's nothing really on the table that we don't do then for a private foundation, including setting them up. So setting them up can be time consuming, it can be very expensive. We can set them up in 3 days. We do them with the Delaware Corporation. So it's aligning with someone like Foundation Source or other organizations that can do all of that kind of back office, tracking, reporting, giving people online access, and basically just running every aspect from a legal compliance, tax, everything is in-house. If you're going to start doing it, working individually with maybe an attorney, an accountant, which you certainly can do, it can get more expensive. It can get harder to manage. So that's why people get mired down and thinking it is complex, and it certainly is when compared to a donor advised fund. But again, aligning yourself with someone that can actually partner with you on it is the key. Myth versus reality. I think this is an important point too. I mentioned it at the beginning, where people think of the old thinking about donor advised funds was like, oh, if you have like under $1 million, then a donor advised fund is the right vehicle for you. It really is dependent on what you want that vehicle for. We open them in Foundation Source for $250,000. We open them for $1 billion. So it's all over the place, and that stat tells it all. 60% of all foundations have less than $1 million. You can form it in, as I said, 3 days. It has a low onboarding fee, and then you can outsource all of those administrative kind of details so that the donor themselves can focus on the joy of giving, basically, and give off everything else to anybody else they can handle. As I mentioned, just to go a little deeper into control, for private foundations versus a donor advised fund. Again, that whole donor advised fund set up under kind of more an advisor model. The private foundation can determine the governance structure and the bylaws. They can govern the foundation alone. They control over the grant making and control completely over the investment decisions. Not that they don't have to report on that, but they can do that. And it can be around forever and in perpetuity. And sometimes donor advised funds are limited in terms of that succession advisor plan. In grant making, that's where the difference is as well. All types, as I said, international grants to individuals, scholarships, direct charitable activities, setting up a soup kitchen, setting up an educational symposium. There's just a myriad of things that you can do and that can count towards your charitable giving. Program-related investments, really giving a nonprofit a loan, basically, and that it is, again, counted as a charitable grant. In the donor advised fund, you are limited to just 501c3 organization. It kind of is a no frills type of delivery, and limited, but definitely growing in the international area. Not that they can't do it, but it is limited. But the advantage, of course, is, and Evelina talked about that, the 5% minimum distribution requirement is a restriction on the private foundation. It is not a restriction on the donor advised fund. And that is it for prepared remarks. And I think we can open it up for some questions. And let us start with, we had some pre-submitted questions that Alvina mentioned, and I'll maybe kick it off, Alvina, and you can chime in or come up with or add another question. One of them was, when would you use a private foundation over a donor advised fund? And I think, like, why would your client want a foundation? Why would your client want a donor advised fund is how I would approach that question. And again, it is the client's needs, the client's objectives, the client's interest. But a client that wants a private foundation is looking for that full control over the investments and the grant decisions. They have their own board. They want to do more with their philanthropy, be more sophisticated, be more complex, leverage different ways of doing it, like I mentioned, giving to individuals. They might have some tangible assets that they want to donate. They don't want those, like art, antiques. They don't want them to be sold. Now, of course, they're going to have to add cash in to fulfill on their 5%, but they can actually keep those hard assets in the portfolio. Grant agreements, which I think are hugely attractive in that they're working directly with the grantee. They're laying out what that grant should be, and sometimes they're multi-year. They're laying out how they want to measure it, the impact that they intend on having, and everyone kind of signs on for that. This whole future generation, multi-generation, perpetuity is another attraction for our private foundation. Why would they want a donor advised fund? Well, they're just looking for ease in administration. I have a donor advised fund myself. Within, 2 minutes, I can make a grant on my phone. There's something hugely attractive about that. They know exactly who they want to give to. They're not looking for strategic help in how they want to do their grant making. They want to give to U.S. charities, and they're happy with that. They don't necessarily care about perpetuity. They're looking really more for like a pass through. And really importantly, one of the great attractions of a donor advised fund, of course, is anonymity. They want to give anonymous gifts. And you can do that successfully in a donor advised fund. With a private foundation, you do have to file a 99-TPF, which is a public document. So I think that kind of hopefully answers that question. If you want to add to that, Alvina, or maybe just answer another submitted question.
Yeah, sure. So I'll just add quickly to that, and then I'll take one of the questions, and I'll ask another question. So, I would say that, I kind of alluded to this earlier in my presentation. A lot of clients have just a private foundation, and a lot of clients just have a donor advised fund. But a lot of clients also have both, right? And this is the slide that I was using earlier that basically said, look, we talked about the 5% required minimum distribution that's out of the foundation. A lot of times clients have both, such that if they, for whatever reason, are not able to fulfill that 5%, meaning having meaningful grantees that they want to make a grant to, they would have a donor advised fund that could receive the balance of whatever's unused in that 5%. So in this way, you are getting the benefits of a private foundation that Jillian talked about, but then you don't have to stress about giving out money from your private foundation up to the 5% required, right, without, before incurring a penalty, and then you could send that to your donor advised fund. The other time I've often seen clients use both is in, bullet 4 here, where if you have a major liquidity event, right? A lot of our clients here at M&T Bank are business owners, right? They sold their business and they have a giant income tax year. And so what they want to do is time your income from a tax perspective, time your big income tax year with a big tax donation year. And for whatever reason, let's just say they've already been incredibly charitable throughout the year, and then depending on numbers shape out, they're not able to maximize their tax deduction utilizing the limits that I set to the private foundation, but they still see many benefits of having a private foundation. This is where, again, it's not mutually exclusive. It's not always one or the other, where you can use both. So you could donate to both a private foundation and a donor advised fund in the same year and have both vehicles. So I just wanted to just kind of add that on, because it is not a one size fit all by any means of a donor advised funds versus a private foundation. So to answer one of the questions that's submitted, I have the list here. Someone had asked, can you talk through the tax consequences to our foundation? So that actually informed us when we were preparing the slides, which I went through. But the one thing I do want to add, which I'm not on the slide, which I do think is important, and I'm guessing the question come from is, when we say tax consequences, it's obviously what the tax consequences is the deductibility when you first donate money into the private foundation. It is the operations of the private foundations, but also be very careful of the tax penalties. And so I'm not sure if this is what the question is, so I want to address that. Of a lot of things that I have said on this particular slide, just go back to it. Oops, no, sorry. Give me a second. Excise business tax holding, excise tax on jeopardizing investment, excise tax on taxable expenditure, minimum payout requirement. If you do these properly, which is why you really need to work with a qualified professional, whether it's Foundation Source or your tax attorney, whoever it might be, it is incredibly important. Because if you don't do those things, there is not only a penalty, but sometimes incredibly onerous tax penalty. So just by way of example, and I'm not going to go through all of it, but by way of example, if you end up having excess business holding, right? If you end up owning more than 20% of a business inside a private foundation, you will get taxed on a penalty tax 10% of the value of the excess holding. And if you do not dispose of those assets within the qualifying taxable period, there's an additional 200% tax on the excess business tax holding. In other instances, such as jeopardizing investments, right, self-dealing, the penalty is not only on the private foundation asset, but also on you as the manager of the foundation. So there's actually two penalties, right? One on the foundation itself for breaking the rules, and then one on the people in charge of breaking the rules. Some of these taxes can be extremely onerous, and then there's also another layer of tax if you don't cure the defect by a certain amount of time. Now, I'm not saying this to scare people from doing a private foundation, because I think there's enormous benefit to it. What I am imposing upon you, all of your financial advisors, make sure that your clients understand, the tax consequences and also the penalty via taxes that could be imposed, and to please make sure you work with a qualified professional.
Great. Another question was, I'll go through a couple of quick answers, but private foundation, should you have an investment policy? I would say absolutely. Private foundations assets are a critical resource, and successful investing kind of requires that strategic plan, provides an opportunity to kind of align their portfolio with their mission, and kind of sets it out as a governing document for the board. So I would say absolutely. It's not a requirement, an IRS requirement, but it's absolutely something that you should do. And then the other question was around multi-donors. I think some people think that, you just one donor sets up a private foundation. You certainly can, and you can have some fundraising activities in a private foundation. Sometimes there's some restrictions to that. You're going to be careful, work with somebody that understands it, but certainly multiple donors can contribute to a private foundation. There are no restrictions on that. Another quick question was around pricing, in terms of private foundations versus donor advised funds. I think there is a kind of another myth about that donor advised funds are a lot cheaper. Again, it depends on who you're working with. It can be very costly on a private foundation to set it up, but if you're working with an organization like Foundation Source that kind of does everything in-house for you, files the 1023, gets your foundation set up, there is a base fee, but it's nothing like if you kind of a la carte it, let's put it that way. So it usually, and it should be on a donor advised fund and a private foundation, less than 1%. And I think in most cases it is. In a donor advised fund, what you've got to be careful for is that you're always presented with an admin fee. It can be around 60 basis points, 0.6% or something like that. But what's not mentioned is the investment fees sometimes. And those investment fees are kind of netted out of performance in the funds. And it looks like you're not getting necessarily charged anything beyond the admin fee, but everyone that's an investment professional on the phone knows that you are. So just have to be careful about that from a donor perspective and giving them the full story. Alvina, I'll pass it to you. I kind of beat it out a couple of quick ones there.
Okay, so we also got a question, which I'll go back to because I just want to make sure. Here we go. We also got a question on how do you convert a foundation to a public charity? So maybe I'll take this question and make it a little broader, which is, okay, let's just say I set up a private foundation and it's not what I expected or circumstances change. What do I do? Okay, so here, first of all, a lot of times what we see is also clients moving their private foundation to another state, either to take advantage of that state law and for administrative purposes. So that is also possible, right? And to do that, it really depends then on the laws and requirement of the state you are leaving and the state you are arriving to. So, so that's definitely a feasible thing to do. Or maybe you just say, you know what, this is change of circumstances. I no longer need the private foundation. Maybe my family and I are not interested anymore, or for whatever reason. So you can, it is possible to dissolve a private foundation or to convert a private foundation to a public charity. But know that there are certain rules and requirements to kind of unwind the entity. So, for example, you need to be prepared to conduct the operations of the public charity continuously for 60 months. And in order for it to qualify as a public charity, you do have to meet the so-called public support test, right? So to Jillian's point earlier, private foundation isn't such that you can only have one donor. But what it does matter in order to flip a private foundation to a public charity is that under the rules of the public support test, at least 1/3 of your donation needs to come from the public, okay? At least 1/3. So if you're trying to convert your private foundation to a public charity, you need to do some math and make sure that on an ongoing basis, that would be feasible, right? This is assuming, again, you are accepting donations, from multiple people and from the public. Generally, the form you will need to file is Form 8940, who's going to notify the IRS that you're planning to terminate the private foundation and operate it as a private as a public charity. Jillian mentioned that as a private foundation, you do have an annual tax form you have to file. That's Form 990-PF. So you would have to file a final Form 990-PF signifying its termination. What I have seen in practice is that a lot of folks, like I said, a lot of people have both, right? They have a private foundation and they have a donor advisement. You can, in addition to your unused 5% distribution every year from a private foundation to donor advisement, you could also pay out the remainder of a private foundation if you choose to terminate it into a donor advisement, if that is your wish. But again, these are complicated legal entities, so it's not for the faint of heart. And I would just, again, strongly advise all of you listening, if that is what your client wishes to do, to make sure you have qualified professionals who are helping you through the process.
Absolutely. I'll just add one more, and I think we can probably go. There's quite a few questions in the box at the moment, but I think one of the questions was, I heard donor advised funds are not going to be around any longer. Well, that's just definitely not true. Donor advised funds, I think, are here to stay. I think there might be some more regulations around them, but they're definitely here to stay. If you look at those stats I gave you at the beginning, and you dig deeper into the Bank of America study, 85% of affluent people give, 22% have some kind of a giving vehicle. Interestingly, though, the largest is what they call, a will as a giving vehicle. There's still enormous opportunity for growth in both private foundations and donor advised funds, but donor advised funds are at 5% of the affluent givers have a donor advised fund, and 2.7 have a private foundation. So clearly, more people have donor advised funds. And also, I think when they ask the question, you're looking at this today, where do you think you'll be in 3 years? 54% of those surveyed said that they were going to establish some kind of a giving vehicle over the next 3 years. So I think that's an interesting statistic from an advisor perspective to note that. and understand that the clients are actually probably looking for you to have a conversation around, again, how strategic can they be and what giving vehicle is the most suitable. Do you want to go to maybe some of the, Alvina, add to that, or do you want to go to the
Well, let me just address one more of the pre-submitted question, because I think it's very interesting, and then Susan will pass it to you to ask some of the questions that are on the live chat. So we got a question about funding private foundation with farmland. And I thought this was interesting because not only does it apply to my remarks is not going to be only about farmland, but about kind of, you know, these kind of more unique, so to speak, like long-term appreciator property, right? So whether it's farmland, real estate, you know, these are the things that I would think about. So yes, is it possible in theory to donate farmland? Yes, but here are the things that I would just be very careful or just kind of think through. One is, as I mentioned, when you are donating long-term capital assets that are not qualifying assets, so meaning not publicly traded stock, you are limited to basis when you are in terms of your tax deduction, right? So, and again, this applies to anything that, you know, real estates are very popular. And so I think that, like, one, you need to understand that. So you can absolutely donate farmland. It's not a problem from a legal perspective, but you might want to make sure, just, you know, checking from a tax perspective that indeed will get the maximum benefit. Specifically when it comes to real estate, whether it's farmland or building, whatever, where there's a mortgage on it, it can get extremely tricky. If you have depreciated on the real estate, farmland, that can also get really tricky. There are some nuanced specific tax consequences. And then on a practical level, right, I think what we need to think about when we're donating things to a private foundation that is not liquid is the 5% payout requirement, right? If you donate farmlands that are you know, fairly sizable, right, that value is counted in the value of the foundation, and then you have to come up with the liquid asset to pay out the 5% every year. The IRS does not care that your foundation have assets that are, you know, not liquid but incredibly valuable. They want to see you pay out 5%, period, end of story. So that gets a little tricky. And also operating in farmland. Now, you know, the answer isn't to necessarily donate to a, you know, donor advised fund or public charity, because I think you will have trouble finding a public charity, you know, unless it's, you know, towards a charitable purpose to operate a farmland. But, you know, there are some difficulties when you're donating farmland or any kind of real estate into a private foundation. Okay. So Susan, I will hand it back to you and I see we have a lot of questions, which is great engagement from the audience. Please.
Okay, yeah, we do have a lot, so let's try to get to as many as we can. So I think, Alvina, you had mentioned about the jeopardizing investments, that
Yes.
was not permitted. So this question asks, what would qualify as a jeopardizing investment?
Okay, great, excellent question. Okay, jeopardizing investments. Let me just go to that slide real quick. Okay, so the IRS defined jeopardizing investment pretty broadly. It's basically like risky investments. So it technically says investments that lack reasonable business care and prudence for either a long or short period of financial needs for the foundation to carry on its exempt purpose. Okay, it's a mouthful, but basically it means things that are risky. There is no statutory, there's nothing in the statute that says if you do these things, these are jeopardizing investments, right? But generally speaking, we're talking about things that are kind of more risky, right? So like trading on margins, for example, right? Selling short, puts, calls, straddles, things that are a little bit more exotic can be a jeopardizing investment. Now, there is, again, no bright line rule of what is. It is a facts and circumstances test, and it is applied based on the time you make that investment. So a classic example we like to use all the time is a lottery ticket, right? I think we can all safely say that, you know, investing in lottery is not exactly the most prudent investment. That would absolutely be a jeopardizing investment, even if you win. Right? So the test to say whether it is jeopardizing, again, is not the end result, because you can invest in a lot of things, right? You know, margin calls, you know, puts, even a lottery, and you win. And you're like, wow, in hindsight, how amazing. The IRS doesn't care. They want to disincentivize behaviors that would jeopardize charitable dollars. So it is, again, at the time of investment, whether a prudent person would perceive that to be would perceive that to be risky. An exception to this rule is what we call program-related investments,
Yes.
and those are investments into specific non-traditional investments that are related to the program and the purpose of the charitable entity. So, for example, if you were, if your charity, if a private foundation is set up to promote kind of, let's just say, investment in the local community, right? And then you end up investing in a local business, right? That, a reasonable person might not always, invest in. That's probably okay as long as it fit within the definition of program-related investment, which is really beyond the scope of this. But I do want to share with you that there's that exception that is becoming actually more and more popular.
Okay, let's move on. Jillian, can the foundation provide scholarships to applicants?
Absolutely. If they want to operate their own in-house scholarship program and directly select winners, and a foundation, they must apply for approval by the IRS. Again, if you're aligned with an organization that can partner with you on that, they can help you with that. And in the application, the foundation has to really define the scholarship program procedure. So to prepare for that IRS submission, you have to be very, very clear, but you certainly can do it. Some organizations give directly to the school, and the school manages the whole scholarship, but you also can do it yourself from a foundation. So yes.
Okay. How long does the formation process usually take, the steps 1 to 5 that Alvina, I think you described?
So I could tell you that, when I used to practice law, I used to be a trust and estates attorney, it could be quite a while, right? Drafting the formulation document, doing the 1023 application. Now that said, that was also many years ago, and a lot of organizations now streamline it. So maybe if I could just take like a data point on Jillian, like if hypothetically clients were to hire foundation source to form their private foundation, how long might that take?
We can actually set it up in 3 days. We set it up as a Delaware corporation, and you can start granting kind of immediately. Now, you would then have 27 months after you were incorporated to file the 1023. So there is, as to Alvina's point, there is a time period in which you're kind of, getting your status and everything from the IRS, because we all know the IRS doesn't move at immense speed. But we can set it up for you, and you can start operating that. We'll help you with the bylaws. We'll help you with the conflict of interest. We'll help you with corporate resolutions. We'll help you set up that foundation, and it can actually be set up in a few days. We do a lot at the end of the year, just like a donor advised fund. Again, aligning yourself with the right organization.
Yeah, and I would say now that, you're looking at Q4, we get a lot of this, right? Like year-end planning is always the craziest time when it comes to professionals like myself and Jillian. So, and with a lot of not a lot, with all the tax deduction, right? If you're trying to time it to get the income tax deduction for 2024, I wouldn't wait until November, right? Even though Jillian did just say that it would take 3 days to set up the private foundation, and we can also help you at Wilmington. Do not do that, please, okay? The time to start is like yesterday, right? Because it does take time to be thoughtful, understand all your different kind of consideration, deciding on a path, and then actually executing it. So if you have a big income tax year this year, and you do want to make the contribution this year, especially for tax purposes, I would very much say the time to start is now.
I completely agree. Yes.
Can the terms of the private foundation be changed at any time, Alvina?
Yes, the answer is yes, with a big asterisk, just like everything the lawyers do and then the law, right? Like it depends. So I think so this is where I think the entity formation gets a big part into it. More and more I am seeing, clients deciding to use the not-for-profit corporation as the entity as opposed to a trust, because it is a lot easier to change bylaws. right? And subject to certain rules, like you can't just change everything, right? But for the changes that most people need, which is kind of, maybe changing the governance, right? Like, I want to have 5 board of directors as opposed to 3, or the term should change, or, I would like to focus on specific things, even though my original purpose of my foundation is very broad. Like those terms can be changed via either a trust amendment if you were to do a trust, or a change of bylaws to a not-for-profit corporation. Without kind of going to the specific of how it's done legally, I would say to you that generally speaking, it is a lot easier to change bylaws in a not-for-profit corporation than a trust agreement. So that's why more and more, although it's not a requirement, I do see more and more people gravitating towards that type of entity. And so, a lot of it's also the preference of your attorney, what they're accustomed to. But I could tell you that it is possible to change it. It very much depending on how you set it up in the first place, the governing instrument, and the laws of which the state of which you're governed, and the type of change you're talking about.
Jillian, what is the minimum recommended for setting up a private foundation, and what are the costs?
So, I mean, there's really no perfect answer to that, but I would say $1 million and over for a private foundation makes more sense. But we can set them up for $250,000, so it can be done. But I would say $1 million and over. Obviously, the fees fluctuate and they go down as the market value or the asset value goes up. I'm just talking from a foundation source perspective now. And so for managing $1 million, it could be around the 1%, maybe slightly over. If we're managing 10 million and up, it's probably more like 5 basis points. So it goes down considerably based on asset value. And then there's also added fees depending on what you want to achieve with your foundation. So if you want us to work with you on setting up applications, for instance, we can do that. If you want some extra help in terms of advisory help around governance issues, around strategic grant making, can be some added fees to that. But that fee that I just quoted you approximately will cover all of the legal and compliance support, all of the tax support, all of the administrative support, all of the grant disbursements and all of that. So it isn't really wildly expensive.
Yeah, and I would just add to that, like when we advise our clients about entity choice, I always want to remind them, we always like to also remind them about the timing, right? Because none of this is a one and done thing, right? A lot of times people do this because they have an immediate idea of what they want to accomplish from a philanthropy perspective, or they have an income tax, big income tax year, they want to take a tax deduction. But to me, philanthropy is a lifelong endeavor that can last for multiple generations. So we certainly have a lot of clients who say, hey, listen, when I passed, I do want a big chunk of my asset to go to charity in terms of a private foundation. So in the long run, when you're thinking about how much goes into private foundation, to Jillian's point, the $1 million, couple $1 million mark might not hit the mark until years later, right? When the people pass, or maybe there's an event of some sort. And then in those cases, what I would say is suggest to you as your financial advisors and talk to what that timing might look like. Okay, if that's what the end goal is, what are your plans and what are your desire during the next 10, 15 years, or maybe shorter or longer, to say, hey, how are we going to fund this? Because sometimes maybe if you look at it from a calendar year perspective, it doesn't make sense because we haven't hit the certain mark yet, but over time it might, right? So to me, again, I wouldn't look at this as a one-time thing, right, but rather as a philanthropic program for the lifetime, or even over multiple generations for your clients.
All right, I think we can squeeze in one more question. Can a family member be a paid board member? Who would like to answer that one?
I'll let you, Albina, just because I'm the disqualified person, I probably have a lot more information.
Yeah, so the
Yes.
Yeah, so the answer, just like the question earlier, is a yes, but with a
Asterisk.
giant asterisk.
Yes.
So yes, the answer is yes. However, you see here on this slide, we talked about prohibited transaction, right? So here's when a lot of people run into trouble, right? They treat the private foundation like it's their piggy bank, and they used to compensate, family members, maybe a child, and that is problematic, right? So it has to be reasonable. So the answer is yes. You can have a family member who is, by definition, a disqualified person, and actually a disqualified person for purposes of these rules, and you can have them serve as a board of directors or a trustee, and they can be compensated, but be very careful because it has to be reasonable. Now, the next question, of course, is going to be, well, what's reasonable? Well, it depends on the size of your foundation, what type of activities you are doing, right? How active it is. There are some private foundations, directors who makes a very significant money because it is running a ginormous business. It's like that, right? So it has to be reasonable within the confines of what you're trying to do. And by the way, the definition, I'm just looking up here because I looked this up because I figured I would get this question, is what is a disqualifying person? So what is the definition of family? It basically means spouse, children, and grandchildren, generally speaking. So that's the definition of family members for as it relates to a disqualifying person.
All right, well, it looks like we're out of time. So I would again like to thank our speakers, Jillian Howell and Alvina Lowe, for a very informative presentation. You covered a lot of ground in a short period of time. And if any of the attendees want to listen again or refer this webinar to a colleague, it will be available for viewing on our website within 24 hours. Once you leave the event, a short survey will pop up in your browser window, and we'd appreciate it if you'd share your feedback on this event because it helps us to provide you with content that you find interesting. On behalf of Trust and Estates and wealthmanagement.com, have a great day.
Thank you.